All right, let's dive into JP Morgan's economic outlook for 2026. And honestly, the main theme is a bit of a head scratcher. They're predicting a market that's surprisingly calm, even with everything going on in the world. So we're going to break down why they think this is happening, whether it can last, and what it all means for investors. Let's get into it. And this quote from Bob Michel really just nails the paradox we're seeing. You'd think with all the geopolitical drama and big policy changes, the market would be a total roller coaster. But instead, it's been pretty stable and profitable too, which, of course, leads to the big question. Is this the new normal we're living in, or is it just the calm before the storm? Well, JP Morgan's report has some really fascinating ideas about what's going on just beneath the surface. So first up, let's unpack why things are so smooth to begin with. According to the report, this isn't just some accident. There are some pretty powerful forces at play that are actively keeping the global economy on an even keel. So what are these big stabilizers? Well, first, you've got central banks like the US Fed cutting interest rates, which makes it cheaper for everyone to borrow money and invest. Second, governments all over the world are pumping cash into their economies with stimulus packages. And third, and this one is really crucial, businesses and regular people have pretty much adjusted to new trade rules like tariffs. And this resilience is a really big deal. Take tariffs, for example. With the average US tariff rate sitting near 16%, you'd expect prices to jump. But a lot of businesses have actually figured out how to absorb most of those costs themselves. That means you and I aren't feeling the full brunt of those price hikes, which has been a huge shock absorber for the economy. And look, this isn't just happening in the US. We're seeing this global push for growth everywhere. You've got a new stimulus package coming in the US. Meanwhile, Germany is planning to spend big on defense and infrastructure, and China is still all in on its fixed asset investments. When you add it all up, it creates a pretty powerful tailwind for the whole global economy. Okay, so with that stable picture in mind, let's get to the main event, the forecast itself. JP Morgan isn't just calling one shot here. They've actually laid out 4 different ways this could all play out. So here's how they see the odds. The big one, the most likely outcome at 65%, is what they call sub-trend growth. Basically, things keep chugging along at a steady, modest pace. But what's really interesting here is they've actually upped the chances of above-trend growth while lowering the odds of a recession or a major crisis. So what do these fancy terms actually mean? Well, sub-trend growth, their main bet, just means the economy kind of glides along smoothly. Above-trend growth would be even better. The economy speeds up and hiring really picks up steam. And yeah, a recession or a full-blown crisis are still on the table, but they're seen as much, much less likely right now. But, of course, it's not all sunshine and rainbows. There is one major risk that casts a pretty long shadow over this whole forecast, and that risk is inflation. And this, right here, is the million-dollar question. What if inflation just refuses to go back in its box? The single biggest threat in this whole report is that inflation gets stuck at a new, higher level, running way above that magic 2% number that central banks are always shooting for. So how could that happen? Well, it's a classic feedback loop called a wage price spiral. All that stimulus we talked about could kick hiring into overdrive. That leads to higher wages, which is great for workers, but it also means more people have more money to spend. That extra demand pushes prices up, which then leads workers to ask for even higher wages to keep up. And you can see how that creates a cycle that is really, really tough to break. So if you're an investor, how do you play this? Where are the opportunities in a world of kind of good growth, but with this nagging inflation risk in the background? Let's check out JP Morgan's game plan. Since the main bet is that the economy will keep growing, the report is leaning into what they call risk-on assets. These are basically investments that do well when the economy is humming along. We're talking about things like hybrid capital notes, which are kind of a mix between stocks and bonds, or debt from emerging markets, which can offer bigger returns. And these numbers give us some solid clues about their thinking. They see the Fed's main interest rate settling around 3.375% by early 2026, with the 10-year Treasury yield hovering around 4%. So the thinking is that rates will come down from where they've been, but they're not exactly expected to fall off a cliff. I love this next quote because it really sums up their whole strategy right now. It shows that they see any temporary dip in the market not as a reason to panic, but as a chance to buy. Why? Because there's a ton of money just sitting around waiting for the right moment to get invested. So let's zoom out. When you put all the pieces together, what is the big takeaway from all of this? Well, it seems to be the real possibility of an extended soft landing for the global economy. And this whole idea, it really comes down to two key things. First, the incredible resilience we've seen from businesses and from regular households who've weathered some major storms. And second, policymakers around the world seem to be in a supportive mood, ready to step in to keep things moving in the right direction. So yeah, a soft landing looks like the most likely path, but it is not a sure thing. The big question hanging over everything is whether that resilience and policy support can hold up against all the constant pressures, things like trade disputes, new leadership at central banks, and of course, global conflicts. The answer to that is what will ultimately decide if this surprising calm is really here to stay.